Francisco Burgos, Head of Investor Relations at Cobas Asset Management, will be the next speaker. Cobas Asset Management Company, Cobas Asset Management was set up in 2016. Francisco García Parames is the co-founder of the company. He achieved returns of 15.5% per year since 1993 to 2014. And Cobas Asset Management Company, Cobas Asset Management has stick to the investment philosophy that led to those outstanding results by Francisco García Parames. They pay as little as possible for the free cash flow generated by companies. They buy businesses with low debt, with good levels of margins, good companies, and they wait patiently for the long term. And Francisco will also briefly speak about Palm Harbor. So they also partnered with Peter Smith, who also has the same investment philosophy with flexibility also to invest in small caps. And we also believe that Peter is doing an outstanding work. We could meet Peter and he's very also enthusiastic about investing. He has the right mindset to stick to his investments for the very long term. And we think that the best is yet to come for both Palm Harbor and Cobas. As it also happened with some other presenters, with this value style philosophy, paying as little as possible for the current cash the company generates. The last years were a bit tough, and also especially with after COVID, some sectors that they favor were struggling, companies in those sectors were struggling, and we believe that after normalization the next years will be very positive for them. He will explain what they do, how they do it, and why they do it. Thank you.
Hi everybody, it is a pleasure to be here with you. It is a pleasure to be in Zurich. My grandfather used to live here, so it is a special country for me. Thank you, Javier, for letting us be here. He's a partner for a long time and we're happy to work with him. My goal within these 10 minutes is to let you know how we apply the principles of value investing and why it is a good choice for your portfolios. So, we are an independent company. The employees of the company are the biggest investors in our funds, okay? And we are specialized in small and mid caps. That means that we will close our international strategy in 5 billion and our Iberian strategy in 1 billion, okay? We are fully aligned with our co-investors. That is mainly because we are one of them. So, this is a story that started 30 years ago, okay, where the investment team were able to deliver an 11.7% of annualized returns, including these years in Cobas Asset Management. I would like to say that we were able to deliver these returns because we are smarter than the market, but sadly, at least in my case, it is not true, okay? Basically, what we look for in companies, how we do it. So, we look for low disrupting risk sectors. That's why we have this industrial bias. We like companies where there is a group of control or a family, because that means that there is skin in the game. We look for companies with competitive advantage. That's something we can feel with the roses. We look for companies with a strong free cash flow generation that grows. That we look for companies that grow it on year-on-year basis. That is like happens with most of the names in our portfolio, and where we have a visibility for around 10 years time. We want to have the time on our side, okay? And we look for all these things, trying to pay the little for these companies, and of course with a little leverage. And this is the team that they've been working together for a long time. Methodology in the process that let us have this good performance in the past, it is because of these guys. Francisco García Parames is the leader of the team. He's the CEO and the founder of the company. And the rest of the guys have been working together for a long time. I would like to highlight Minkun, that he is covering the Asian market, and he's been working with us for 17 years now. Okay. So we look for value in all the countries and in all the world, but we want to be close to the names where we invest in it, because being close of the companies is something very important for us. Even being Francisco the leader of the team, all of them are co-portfolio managers, okay? They have to come up with new ideas for the portfolios. So if one of the members of the teams find a new idea that they developed a model, not that detailed, where they're trying to find if it gives upside and quality to the portfolio. If he thinks so, he shares it with another two members of the team. One of them is going to be Francisco García Parames, and the other one, they will look for synergies, because they're generalists, but they have some specialization on some sectors. So they go in depth in the quality and in the quantitative side of the model. They vote for it, and it goes to the investment committee, where all the members of the team got to prepare or to study this new investment thesis. And if they agree, and if the majority of them agrees with the inclusion of this name, we will invest into it. And we will invest with a weight of a 0.7 to 1%, not over that. And if we don't tend to concentrate, we don't have any fear in concentrating, but we have to spend time on this company in order to know more about this company, know more about the management team, know more about if the projects are being delivered well, and also because we wait for the new windows of opportunity. And if we find eventually a company where we think that the free cash flow generation, it is very difficult to be reduced, we can concentrate, if we believe in the company, for over 4.5%, 5% onwards. Okay, we have currently a couple of companies only with over 5%. Okay, but the top 20 companies in our portfolio weighs around 60% of the portfolio. So this is our portfolio. As I was telling you in one of the first slides, we look for high quality companies. There you have ROCE of 34%. These companies are trading at 6.6 times PE. We have time on our side. As you can see, it's 5 years. The companies we invest in are generating what we've paid for them. So times on our side, if the market do not pay attention to them in 1, 3, 5, 7 years, they're creating value for us. And lastly, the EBITDA. Our companies are deleveraged. They have 0.2 net debt EBITDA ratio. So there's not a risk in our names. During the last years, we had a very good performance. Due to the nature of the companies we invest, we tend to have a very solid performance, and we go with the benchmarks. And some years we have this difference in terms of performance. So as you can see, in 2022, we were able to deliver close to 10% of performance, while the market was dropping in all the asset classes. 2023, the market rebounds, and we're not that far. And this year, the performance has been quite good because some of our top names are starting to get into the target price. The market is paying attention to them. But still, we have a long way to go. We've been invested in our top 20 companies for almost 6 years now. So the level of conviction in all of these names is absolute. And we have a portfolio. The window of opportunity is so good because the portfolio values 2.4 times more than the price, than the market says today, than the NAV of today. And what is the structure of the portfolio? Well, our colleague Alex talked about the opportunity that there is in the energy sector. We invested a long time ago and we earned a lot of money into that. What we basically do is we tend not to invest in commodity business related businesses because we don't know what the price of the commodity is going to be, so we cannot have this free cash flow visibility. That's why back in the days we started to invest in LNG infrastructures, contracts with over 20 years time, so we know all the free cash flow generation that they're going to have. We invested in engineering of oil and gas services because we knew that there were a lack of capex in this. There was a lack of capex in the sector, so we put money into that, and still we have some money there. And one of the only changes we've made since the launching of the portfolio was the investment on oil and gas producers. But normalizing the price of the oil at $65, they're trading at 3-4 times. So we don't have this visibility in terms of free cash flow, but in a few years they're paying what they generate what we paid for them. So the analysis here is based on the corporate governance. Does the company pay when they're in good times, or like other commodities companies, they do not share in terms of dividends, share buybacks with the shareholders. In some words, it's are they aligned with them? Then we have 32% in defensive names that match quite a lot with our philosophy. We also like to have between 15 or 20% in cyclic names. As the investment process is so long, we never know when the bottom is going to happen. What we do is we control a cyclic sector is buy some shares while the market is dropping, while the market is punishing them and the price is dropping. And then we have a 10% in commodities, always with a value approach. We normalize the price. For example, we have a mine of copper. We are normalizing the price of $3.5 per pound, which has been over 4 whole years. So we're very conservative with the assumptions. And this is one of the investment theses that shows perfectly what we do, and shows also that why we are not afraid of concentrating in a name when there is a high level of conviction. So Babcock, it is a defense business in the UK. They have 2 business lines. They do the maintenance for the nuclear submarines for the Royal Navy. There is not any other facility in UK, so basically they cannot change the provider of services. And they also do the maintenance of the nuclear energy, which is very sensitive, socially speaking. So the switching costs are huge. There is no incentive for changing the company. There is a huge interdependence between the UK government and the company and vice versa. And what the numbers are. The net profit normalized for 2026 is going to be of 360. We normally apply to a company a multiple of 15 times. If it is commodity related or cyclical business, between 10 and 12 times. And this one, as it is a high quality business, we're applying a multiple of 17 times, which is, if you take a look to the peers, the lowest one that the rest of the peers they have. So if we multiply this after a normalization, we do, of course, against the net profit, we're still seeing a upside potential of 130%. This company performed in 2023 at 40%. It increased its price over 40%, and this year I think it is around 15%. And still it has all this value, and we've been invested into this company for over 6 years now. Okay. So the conclusions, the ideas I want you to keep about our company, it is like we have a great potential in our portfolio with a team and a process that has worked for over 30 years' time, with a deep knowledge in the companies, in the top companies. As I told you, we've been investing into them almost 6 years now. And above all, I think we have a portfolio valid for any market environment in terms of free cash flow protection. And that's it.
Peter.
Now, Peter, we will present his...
So you briefly explain 2-3 minutes.
One of the goals within the company, we use 15% of the income of the company to fund different initiatives in impact socially. One of the initiatives it is to help to foster independent investment managers. One of them is Peter. He's under our umbrella in Luxembourg, and he's a focused on the small caps, and he's been delivering very good returns. In fact, he was named by Citywire the best small cap fund in Spain. So he will explain he will talk about the fund now.
It's time you can stay here, Francisco.
Okay.
Because so Peter finally couldn't join my video, so that's why I asked to please start with an intro. Before you can, I think, summarizing it. So
I can do the presentation for him. Okay.
Very briefly, just 2 or 3 4 minutes,
Yeah.
and then questions and answers for you and for Panja.
So basically, Peter Smith, he joined Cobas in 2017 with the promise from Francisco García Perames of helping him to launch a new fund. So after everything, after a couple of years, we seed his fund in Luxembourg. As I told you, it is same principles, same philosophy we have. And they focused on small caps, mostly in Europe, which is where he had the chance of visiting and be close of this management. As you can see, the total returns have been quite good for the moment, and still it is a good moment as our colleagues in VWM share with us. Small caps and value investing has been very punished during the last years. So the chances, the polarization in the market created a huge opportunity on this side that eventually will reverse to the mean. But he's been able to return to give back value even in this situation. He started in 2019, so it's been a 5-year period of time, which is, I think, it is not bad. Well, here is Peter Smith. After, if you want to get in depth in the fund, I will be happy to answer that. But he follows the same principles we have, and I don't know if we have a investment idea, but okay. They have, for example, this is one of the names he could invest. It is a small cap. It is a hotel value chains in Barbados. What happened? Basically, tax changes ended up into neutral improved for hotel industry. So there is no capacity to invest more in hotels. They have the hotel. They are the hotels they have. So it is not possible to get into this market. So they have kind of a competitive advantage in terms of that. It is not possible to create more business onto that. They received a takeover bid at 55 premium from Marriott, so it was a success opportunity. But this is the kind of things that they can take advantage of.
Do you have any questions for Francisco? About one question.
Yeah. It's really a very attractive enterprise companies, but as you mentioned,
I cannot.
Could you say it louder, please, Alex?
If you compare the performance of Babcock, it's 5 years relative to Thales or Raytheon, who are also in defense, there's a huge difference. What is the main reason of the underperformance?
Well, when we invested in 2017, the problem was that some peers had committed fraud in their accounts. If you add to that Brexit, the company was so cheap. They had no trust from the market, and then the COVID appeared, and that created that some of the business were affected because they have a TIR with the submarine business of around 12%, but in the contract is of 8%. So if they're able to cut costs and get better results, they go to this 12% easily, which is the main driver for our investment. And with COVID, that disappeared. So they had to divest in some of non-core businesses, as they had like high quality businesses, price that they sell were good, and they were in this process of normalization of the business. In fact, presented results today, and it is up to 7% in the day, because the results are being very solid during the last quarters. As it is a very solid business, they don't share a lot of information. They present results a couple of times per year, so they're in this process of normalization. So from now on, I'd say that market is normalizing the price, but when they present results, they will go towards its target price.
Thanks.
See you.
Thank you, Francisco. Another question.
Yeah, just a quick one. It's very interesting. You said your investment process you collectively decide. So
yeah.
What is the matrix that you use? How do you rank the ideas from everybody that come with an idea? And equally, how do you decide to sell?
How we decide? Yeah. So as I said, it's about portfolio management. So there is first an individual process. They have to come up with new ideas, and they have to analyze within a framework they share. It is not like each one of them has its own process. They have a framework to work with. This fast process, upside is good, quality is good. They develop it with the same framework, the whole model, and it depends the duration of this process. It could take. It depends on the sector. If we know very well the sector. It is kind of a democracy. Of course, at the end, it is an opinion. So, of course, I'd say that Francisco García Paredes in the investment committee opinion would weight more than others' opinions. But at the end, they have to vote. It is true that there is a golden vote, but usually they don't. He doesn't use it because they have the same mindset. Same philosophy, I say. So they have disagreements, and that's what we need. Okay. Apart from that, we're long-term investors, but we're constantly making adjustments in the portfolio. So if a company today increases its price at 20%, we tend to reduce. And if another one drops, we sell some bips from one side and buy the other. It is true that we do not invest usually over 15% on one sector. So the companies while they are getting close to its target price, we start to divest gradually. When it is now, with the upside we have today, when it is around 50 to 60%, we sell the whole position. Yeah, but it is true that as of today, it is very, very difficult if in a binomial of quality and upside and conviction. It is difficult to find new ideas. So, for example, this year we only included around 4 names, and with a tiny weight. It is kind of a watch list. You know, we have 30 names, we have 55 portfolio companies, and top 20 are very concentrated, not very, but the rest it is kind of a special watch list of companies we want to follow closely. It is not the same to analyze a company and only have the model that being invested in this company for 2-3 years. That's very important in our experience.
Thank you.
Thank you.
Now it's time for the